Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing British American Tobacco stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. British American Tobacco manufactures and sells cigarettes, tobacco, and other nicotine products. It is the largest tobacco company in the world based on revenue. It has operations in 180 countries, and its cigarette brands include Dunhill, Kent, Lucky Strike, Pall Mall, Rothmans, Newport, and Camel. Its e-cigarettes are Vipe, Glow, and Velo. The company is headquartered in London, England, and was founded in 1902. It started trading in 1998 and can be found on the New York Stock Exchange, Mexican Bolsa, Deutsche Börse, London Stock Exchange, Xetra, and Johannesburg Stock Exchange. It is part of the FTSE 100 index. The growth of its non-combustible customer base is expected to reach 50 million people by 2030 and add £5 billion of revenue by 2025. Combustible tobacco products require burning of the product for consumption, like cigarettes and cigars. E-cigarettes and chew are examples of non-combustible products. According to studies, most of the harm from tobacco is caused by combustion, not nicotine. As less and less people smoke cigarettes each year, these types of alternatives, as well as higher cigarette prices, help this company grow and return great value to its investors. The total addressable market of smokers switching to safer alternative tobacco products is growing from 33 million in 2015 to 79 million in 2020 to an estimated 123 million in 2025. This company is always up against lawsuits, high governmental regulation, and excess taxes. Many investors do not invest in companies like this due to its negative moral and environmental effects. Just something to consider when investing in a tobacco company. Let's get started with the model. This is a large cap company, 86 billion market cap. They're trading at $37 a share, and they have 2.3 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they have tons of free cash flow, 13 billion. It is the lowest in the trailing 12 months, but close to 11 billion of free cash flow. That's still a ton of excess cash to work with. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that's around $8 billion to $9 billion a year. Revenue is the sales for the company, and that's around $34 to $36 billion a year. The huge tobacco company Altria that makes Marlboro cigarettes, they only have 21 billion of revenue. This company did 36 billion. This is the company's income statement. The top line is the revenue, the sales, and all their numbers are in British pounds. I converted the numbers to US dollars on my Excel spreadsheet since I'm looking at the ticker that trades on the New York Stock Exchange. They're really trying to grow their non-combustible products. Plus, by focusing on non-combustible, it gives the impression that they're trying to be a healthier company. As you can see here, 88% of its sales come from combustibles. That's mainly traditional cigarettes. The company generated 13 billion pounds of revenue in 2015. They doubled that. It's up to 26 billion. It's really hard to grow from 13 billion to 26 billion. It's a million times easier to grow from 1 million to 2 million. Below revenue is the cost of revenue. These are the expenses that are directly related to generating the revenue. So when the company buys tobacco from farmers, that goes in the cost of revenue, the amount they pay to the farmers. And the amount they charge to consumers, that goes into revenue. Revenue minus cost of revenue gives you your gross profit, and they have a ton of gross profit. Their margins are amazing. Below that is operating expenses, and their big operating expenses are litigation costs, marketing, and depreciation. Because this company is always fighting lawsuits. That's a difficulty about being a tobacco company, is there's always lawsuits. Gross profit minus operating expense gives you your operating income, and they have 10 billion pounds of operating income in the trailing 12 months. They do have quite a bit of debt on their balance sheet, so they paid 1.7 billion pounds of interest on their debt in the trailing 12 months. And the bottom line of the income statement is their net income, which is really strong each year. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. So net income is your accounting profit or loss. That's not actually how much cash you generate, because the income statement has a lot of non-cash items on it that bring down your net income. Even though they reported a profit of about £6 billion, they actually generated £8.5 billion of cash flow. That's just cash they generated from running their day-to-day operations. Since they're a manufacturing company, they have to make the products. They gotta always have a good amount of money they have to invest in CapEx, because they have to buy equipment, machinery, and buildings and factories to make the products. So they spent 700 million up to 900 million pounds in CapEx. Operating cash flow minus CapEx gives you your free cash flow. So after investing back into their business, they still have a ton of excess cash flow. And they give most of their cash flow back to their investors in the form of dividends. They don't really buy back too much stock. And they've been paying down debt each year since 2018, as you can see here. This is the equity section of the company's balance sheet, and they have 63 billion pounds of equity. They raised 27 billion pounds from selling stock. And retained earnings is the sum of all your prior net incomes minus the sum of all the dividends you paid. So even after paying all those dividends to their investors, they still had an additional 43 billion pounds of profit. So this company is a cash cow. Let's look at their capital structure. 87 billion of equity, 63 billion of debt. They're 58% equity, 42% debt. And their weighted average cost of capital is 6.9%. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4. That's 283 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $259 billion. We divide that by 2.3 billion shares. And we get a calculated stock price of 113. They're trading at 37, so they're trading at a really deep discount, a 67% discount. So when you value a company, you have to estimate their future free cash flows. Free cash flow is a cash that's remaining after operating a business and investing back into the CapEx portion of it. So a company can do whatever they want with free cash flows. They can use those free cash flows and buy up other companies and grow. They can use those free cash flows to grow their organic operations. They can also buy back stock, which will increase the stock price. Or they can pay a dividend. This company chose to pay a dividend. Even though I value their future free cash flows at 113 a share, it won't go up to 113 because they're giving you most of the money back as dividends. If they did not pay a dividend, they used all that money to buy back stock, then your stock price would go up since the company's buying back a lot of shares, which reduces the shares in the market, giving you a bigger piece of the pie. So let's just make it easy. They're right now paying 8% dividend to you. Say they use all those dividend funds to buy back stock. The stock would have to go up 8%. So whether the stock goes up 8% or the company pays you dividends of 8%, it's really the same thing to you. You could take that money from the dividends and go on vacation. Alternatively, you could take that money and buy more stock, which means you'll get more dividends in the future because you own more shares. Simply Wall Street is lower than me. They're at $81 a share, so they're saying the stock is 54% undervalued. 2 analysts priced this stock and the average price target was $50. So pricing a stock is a lot different than valuing a stock. Just because I think a stock is worth over $100 a share, I don't think it will hit that level because they're paying you all those dividends. So I do think $50 makes sense. If I was to price a stock, I'd probably put it around $60. This is where the stock has been trading since '85. So if you were able to buy the stock before 2003, your dividend yield would probably be like 30-40% because you'd be getting that higher dividend based off of that lower stock price. It was trading at about $70 a share, but at the end of 2018, the stock really dropped a lot, and it hasn't come up since. So you can see from this article, tobacco stocks were the hardest hit in 2018. And this stock was hit even harder because I guess the investors didn't like when they acquired Reynolds Tobacco. Because the United States mentioned is trying to cut the amount of nicotine that's used in combustible cigarettes, also putting heavier regulations on menthol cigarettes, also trying to ban e-cigarettes and vaping products. But we'll be talking about this to the end of time. People are going to always complain about this, but I don't think there's ever going to be a ban. There may be more regulations, but these products will continue to be sold. And these are legal products. People can make their own decisions when buying a product. The stock has done pretty well the past year. It did take a dip right here, but it looks like it's going up overall. Most people who buy this stock and are holding it long term do so because of the dividend. They pay an amazing dividend, 8%. They pay out 79% of their net income and 63% of their free cash flow. So they can afford to continue paying that dividend payment. And their industry pays a 6.3% dividend. They're higher than their industry, and analysts are forecasting their dividend to grow to 8.5%. The stock has a pretty low beta, 0.72, so it's not too volatile. The stock has gone up 10% in the past 52 weeks, while the S&P went up 32%. The 52-week low was 32, the high was 41, and the stock is trading below its 50-day and 200-day moving average. About 2.5 million shares are traded each day on this stock. Of the 2.3 billion shares outstanding, 2 billion are on float. Only 6% are held by institutions. I think Altria has 60% institutional ownership. Their institutional ownership is probably low because it's a non-US based company. And hardly any of the shares are shorted. The stock is up 21% the past year, but it's down quite a bit the past 3 years and 5 years. Analysts are forecasting their earnings to grow 7.5%, their revenue to grow 3.4%. But growing 3% for this company is like growing 50% for other tobacco companies. Not Altria, but other smaller tobacco companies. And their earnings have struggled, down 13% on average the past 5 years. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you would have been close to $20,000 at one point. Then your total investment would have been below $10,000. But if you're still holding on, you'd be at $14,000 today. That's a 3% annual return. But if you could have bought down here, or even right now, I think you're getting a great discount. The biggest shareholder is Capital Research at 12%, then BlackRock, Spring Mountain, Portfolio Services, and Vanguard. Let's look at their financial ratios. They have an amazing PE ratio of 10. The market median is 22, the average is 33. That means investors are paying $10 for $1 of earnings. Value investors feel a PE below 15 is a great value, so 10 is amazing. They also have a really good price to sales ratio of 2.4, a really good price to book of 1.0, but they have a ton of intangible assets on their balance sheet, so their tangible book value is actually negative. Their return on invested capital is pretty good at 7.2%. I like to see an ROIC greater than a WACC, which this is. They can cover their interest payments 6 times. They have a good ROE at 10%. And they don't have enough current assets to cover their current liabilities. They generally keep a current ratio below 1. So if you invest in a company that loses money each year, and they have a current ratio below 1, that's a problem. But if you invest in a company that's really profitable like this company and has a ton of cash rolling in, it really doesn't matter if they have a current ratio below 1, because they can just wait a few weeks and another $1 billion will roll in. Or they can always take on debt if they wanted to. But they just have so much cash coming in, it doesn't matter. They don't need to tie up all their cash on their balance sheet. They give most of it back to their investors or possibly to acquire other companies. So I wouldn't worry about a current ratio below 1 if the company is really profitable like this. The best way to look at ratios is to compare them to companies in the same industry. The only other company I did in this industry was Altria. And BAT has much better price multiples. They're also higher in current ratio. They're both pretty similar in ROE. Altria is 90% debt. BAT is only 42%. And they're both pretty close in market cap. And BAT pays a higher dividend at close to 8%. You can tell if BAT was an American-based company, their market cap would probably be $150 billion. But they're a non-US based company, so their market cap is similar to Altria. And BAT is almost double in revenue. So to summarize, I have them trading at a 67% discount. When this stock dropped a lot in 2018, it seemed like a really great time to buy. And if you bought in 2018, you're still sitting there waiting. It's 3 years later and the stock hasn't moved too much. You do get your 8% dividend, but if you bought it in 2018 when it was cut in half, you would have thought by now it would have went up a lot, but it hasn't. That's the tricky thing about investing in a company like this. There's a lot of investors out there who just won't invest in them for moral reasons. And I totally get that. And the reason I generally don't invest in these companies is because others don't invest in these companies. My goal is to make the most profit possible. And with these companies, they don't get as much activity because of the negative connotation tobacco companies have. And I know there's lots of studies that say tobacco is linked to cancer, but there's also a lot of studies saying eating a high-fat diet is linked to heart disease and diabetes. But we'll never ban food. We can't. But I do think it's trading at a really great value. Plus the dividend is amazing. I rank their free cash flow 7 out of 10, their revenue 8 out of 10, and their ratio is 9 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.